Welcome back to the program. Well, we have just over 10 minutes left until the close of trade on Wall Street. All of those indices in positive territory. The energy space really leading the way higher there on higher oil prices, and of course the market digesting the second presidential debate there. So we are seeing another good move, although noting that it is the Columbus Day holiday where a lot of those US banks are closed. The US bond market also closed, so relatively light trading volumes that we are seeing going through. Now let's get across those moves, particularly starting off with the commodity space. Joining us is Tim Evans from Longleaf Trading Group, live from the CME in Chicago. Tim, wonderful to see you there. Thanks very much for joining us. Now, I just wanted to start off with gold, because of course the gold market is really on the heels of what was a terrible week last week. We were down about 4.5%. I think the worst week since 2013. We fell below that key 1300 level. There's a lot of talk of rate hikes, of course, dollar strength. Tell us, in your view, what's really contributed to the move in gold at the moment?
Yeah, I mean, well, first of all, thanks for having me on. But with respect to gold, last week was a very tough week. You know, if you were a gold bull, you went home over the weekend with broken spirits. That accelerated move, clearly again was, really led by anticipation of a Fed rate hike, very strong dollar. But if you look at it in the context of kind of where we were, we had a humongous long position in the market, upward of about 334,000 contracts. So whenever a market gets that long, it's very susceptible to very aggressive sell-offs. And I think that's really all we saw, the market being cleansed a little bit, and, over-leveraged longs were definitely driven to the sidelines.
So there was a lot of long-term buying interest in gold at those discounted prices.
Yeah, I mean, again, it always feels worse than it is kind of in the moment. But if you look at the price action of gold, in context of the rally that started back in late December of 2015, the pullback that we've seen here right around that 1260 level is we've only accomplished the first Fibonacci retracement, at the 38.2% retracement. So, this is actually a very healthy, predictable pullback that we're seeing. Frankly, I think we're at key support levels here at that first fib. And, if you're looking to position for the long term, I think these price levels are quite attractive.
We were actually just looking at a chart on the screen, and we might just bring it up again. It's sort of showing that a technical indicator is signalling a potential rebound there. A lot of the gold bulls may just catch a break after that loss that we saw last week in gold. I mean, a lot of it is down to what the Fed does at the moment, whether they raise rates this year. Obviously, that US dollar strength, as you mentioned. When do you think would be a good time to start buying back into gold?
Well, the markets go in cycles. I mean, right now we're caught in that cycle where all we're focused on is what the Fed's going to be doing and when they're going to be doing it. But at the end of the day, we have to ask, all right, if in fact they do raise rates, which I indeed expect they will, what is the impact of that rate hike going to be? At the end of the day, with a Fed rate hike, that's not going to solve the long-term systematic problems that we have that gold will respond well to. Gold being a flight to safety vehicle. So I think on the other side of a Fed rate hike, gold is actually positioned to perform extremely well.
What about oil? Because crude oil is continuing to move higher there today as well, and the market is continuing to buy the rumour. I think that is the key word there, the rumour on production cutbacks from OPEC. We've heard those comments from Russian President Vladimir Putin. What are your thoughts on this? I mean, should we be cautious until that November meeting, until we actually do get some sort of concrete deal in place?
Yeah, I'm looking at this from the context or from the perspective that they're not going to come together for an enforceable agreement. So I think a lot of this buying the rumor type price action we're seeing is actually setting up a relatively good short side opportunity. Because even at the end of the day, if OPEC and non-OPEC members are able to come to an agreement and, one that the market feels that they'll be able to enforce, at the end of the day, crude oil, there's really no path for it beyond, $52, $53 in my view. So from a risk to reward standpoint, I think the short side of the market is much more attractive than the long side.
Okay, so you should be shorting the market at the moment. Well, I guess on your view that any sort of agreement is doubtful if we don't get any sort of deal in November, you think that shorting the market now is a good opportunity?
Yeah, I mean, because the market's pricing in, the fact that they're ultimately going to come and make an agreement that's going to be enforceable. So if that in fact does happen, and we've already, priced that in to a good degree, which I think we have now, there's really nowhere else for the market to go. That means the market did a pretty efficient job of pricing that. So again, from a risk to reward perspective, I think the short side of the market provides the best opportunity at these price levels.
From a derivative or an option standpoint, I mean, the VIX on oil is up about 5% or so over the last couple of trading sessions. What would be a prudent play in terms of, that context?
Yeah, I mean, that's exactly right. And that's at Longleaf, that's exactly what we're looking at. I mean, we're up about 5% here in terms of the oil VIX over the last couple of trading sessions. So option premiums have gotten a little fatter, as the markets continue to see this upward movement. Anytime you can collect more premium, that allows you to reduce your risk by that exact same amount. So, we think selling call options, in this run that we're getting here to the upside is the way to go. Obviously, depending on what your risk to reward profile that you desired in the position will kind of determine what those strikes you would select would be. But, at the end of the day, I think shorting premium up here is the way to go.
Mm-hmm. Let's look at the broader market today. I mean, we've been talking a lot already about a mix of factors at play there today. What are your thoughts on why we are seeing those equities rising?
Yeah, this week it really got started last night. Asia or China had a national holiday, so they've been out of the market for a few days, and they came into the market pretty aggressive on the open last night. So the buying really began, and that coincided at the same time we had a presidential debate kicking off here in the States. Depending on how you view that and what the impact that could have on the market was in a pretty good mood here as we started in Chicago this morning, and the market was able to continue that momentum early on. All
right, fantastic. Tim, we might wrap it up there, but really appreciate you joining us. Thanks very much for your time.
Thank you.
Tim Evans joining us there from the CME.